In general, banks are sound, and the major regional and global banks are extremely sound. In past crises, the financial system tended to transmit and amplify shocks. The reverse is true this time around. We are in the very fortunate position of being able to help to alleviate this crisis by dampening and reducing the shock to the economy. Banks can certainly assist our clients a great deal during this crisis, but there are some things that we can't and shouldn't do. Obviously, commercial banks can't increase the dollar supply, as I've just said. That must be left to central banks. And one must certainly give credit to the central banking community for their commitment to pumping liquidity into the system. The commercial banks can't put the interests of our clients at risk. An obvious but essential point is that banks' clients are savers as well as lenders, and they are institutional investors as well as corporate borrowers. Whatever else we do in this crisis, our first duty remains to safeguard our depositors' funds. We must, therefore, continue to apply the usual rules of good lending practice, starting with the retail and commercial side of things, and using South Africa and Kenya as examples. In both countries, we are offering installment relief to categories of clients, including low-income earners, students, and small and medium enterprises. In cases where clients have credit insurance, we're helping them to claim to cover lost income or retrenchment. We can also reduce insurance premiums in some cases. For instance, in South Africa, in specific places where clients are driving less during this lockdown, we are refunding a proportion of their premiums. We have also reduced transaction fees in several countries. One initiative that I particularly like emerges from a service that we have already developed in South Africa called Simply Blue. This is essentially an online business in a box for SMEs, enabling them to set up a retail website and payment system in a matter of minutes, and so shift to online retail very cheaply and very quickly. On the corporate and investment banking side, our view is that there is no substitute for client-by-client engagement. We do not believe that it is practical or appropriate to contemplate sectoral, segment-wide relief measures. In every case, we need to distinguish between existing and new clients, between expansionary and crisis-driven requests, and between local and foreign currency funding. We also need to think carefully about the availability of additional collateral, remediation actions by clients to reduce expenditure, the strength of management, the business's market position, funding available from shareholders, as Kunle pointed out, as well as government and other lenders, and our own funding capacity. Over the last month, we have provided several $100 million worth of relief to many of our corporate clients. We have also been able to assist corporate clients in helping their staff, and we are offering concessions with respect to pricing of our advisory work during this crisis. The commercial banks will be able to do a lot more lending in support of the post-pandemic recovery, thanks to the regulatory changes made by central banks, including the South African Reserve Bank. In essence, these rule changes make it possible for us to lend larger sums for longer periods against our existing capital and liquidity. It is very useful to remember that banks can, as a rule of thumb, make loans up to 10 times the value of their equity. So interventions like these can be very efficient ways to kickstart the recovery. As it happens, President Ramaphosa announced South Africa's loan guarantee scheme just last night. It had been developed in partnership with South Africa's commercial banks and provides around $15 billion in guarantees against which we can lend to companies with revenues below $20 million a year. Standard Bank's view is that this is an extremely well-designed program that compares favorably with the best in the world, including the United Kingdom and the Swiss schemes. It provides a great deal of support, but crucially, it does not require banks to lend in an unsustainable or unsound way. In other words, it provides a very valuable bridge to get us across a very difficult period. But it doesn't introduce any longer-term distortions that could delay or prevent the post-pandemic recovery. We don't know exactly when the recovery will come, nor do we know if it will be a V or a U or a Nike swoosh. But the recovery will undoubtedly come. To my mind, banks can be most useful of all in reinforcing and accelerating the recovery phase when it happens. And this in turn has two implications, which basically summarize everything I've been saying. It is essential that the financial system remains sound. I think what is really important is that the authorities implement structural reforms that are on the table as a matter of extreme urgency. And again, it's been good to hear ministers and the president speak quite eloquently about the need to get cracking on the various structural reforms. And so I think what we will see in the next phase, simultaneous with the stimulus packages, is you're going to see, I think, execution on the structural reforms. I do think that our leaders have an opportunity to leverage the African Union and take action collectively and introduce measures that would address medium to long-term structural changes to the continent that would help with the movement of goods, people, and capital, and therefore address the challenge that we face. So firstly, it's the African Union having a scientific and integrated response to COVID-19 as a continent, but then secondly, an economic response as well. And then, of course, from an economic perspective, to use the leverage that will come from the intercontinental free trade area, accelerate the execution of that agreement, and get the economic benefits that arise therefrom. Review your capital sources, and as we've all said on this webinar, various countries have got some very useful solutions designed between the private and the public sector, firstly. Secondly, people should review their insurance policies. Don't forget the existence of business interruption insurance. And then thirdly, like any other business, sit back, do scenario planning, figure out which are the most likely scenarios and prepare your business for the most likely scenario.